Hello and welcome back to the course. In this lecture, we are going to discover the basics of bookkeeping. You will learn how to record transactions of a small business in its financial ledgers, and in the next lecture, we will make our first financial statements. Let's go!
First of all, let us talk about assets. An asset is anything that brings value to the company, that the company uses to do its business. It can be money, like cash at bank, or money that other people owe you. It can be goods, which is called inventory. Inventory is any goods that you are going to sell to your customers or materials that you're going to use in your production process. The next kind of assets is fixed assets. This is heavier stuff. This is buildings, machinery, trucks, anything that will be used for a long period of time. There are also other kinds of assets that we're going to talk about later throughout the course. The money does not grow on trees. If a company wants to buy an asset, it should get its money from somewhere. There are two sources of assets. You can either use borrowed money, which is called debt, or the company can use its own money, which comes from two basic sources. Either investors, the shareholders, gave it to the company, or the company can use its own profits to purchase some assets that it needs. We also need to talk about the accounting term of accounts. What's an account? As you have seen before, companies have many different kinds of assets and sources of assets. It's cash, receivables, buildings, loans, payables, share capital, profits and losses. Each and every kind of asset or a source of an asset is an account. Cash is a separate account. Buildings is a separate account. Machinery is a separate account. Every account has a value, which is called the balance. The balance is just the value of the account at a specific date. For example, cash at bank of $1,000 as of the 1st of January 2023. The accounts in accounting can only hold monetary values. For example, if you own 2 trucks, your account trucks does not state 2 trucks, but it states the purchase price of these trucks. For example, if you bought those trucks for $100,000 a truck, then the account value will be $200,000. So we have talked about accounts, account balances, and now it's time to talk about our great accounting equation, which is also called the balance sheet equation. The point is, this equation always holds true. So assets of the company are equal to the sources of those assets, namely debt and equity. Assets are commonly referred to as the left-hand side of the balance sheet, and the sources of assets, namely debt and equity, are referred to as the right-hand side of the balance sheet. So the left-hand side of the balance sheet is equal to the right-hand side of the balance sheet, and it is always true. For example, if you take out a loan of $100, then you get an additional cash of $100. And also on the other side of the equation, you will increase the account called loans by $100. There is another case when you do not change both sides of the balance sheet equation. For example, you purchase goods for $50. In this case, you have minus 50 cash and plus 50 of inventory. The total is 0. What happened was that you basically exchanged one kind of asset into another kind of asset, and nothing changed in the sources of assets. And it didn't require any additional financing using debt or equity. In order to show you how to record the business operations into financial ledgers, we are going to live with a small company for a couple of years. So you decided to organize your own small business. First of all, you got to have some cash. So you invested $240K of your own savings into the company. Then you wanted to sell something, so you needed a warehouse. So you rented a warehouse for 2 years. The cost is $60,000 per year, but you got a discount and you have to pay $120K in advance. So you paid in January of 2023. Then you have to somehow obtain the goods you want to sell. And then you purchased $100,000 worth of goods. Fortunately for you, you won't have to pay anything for those goods in 2023 you will pay your supplier in 2024. During the year, you sold half of the goods for $240K, of which you collected $200,000 in cash, and you still have to collect $40,000 that you still owed by your customers. Also, you had some personnel expenses. You hired some employees for your warehouse, and you have calculated that their salaries and bonuses will be $100,000, of which you paid $90,000 in 2023, and then the rest you are going to pay in March of 2024. So let us see how these operations will be reflected in the financial ledgers of this new small business. So we will record the operations using a small Excel spreadsheet that I've prepared. You can download this template in the resources section for this lecture. So this is a basic accounting equation that we're going to be using. There's the left-hand side and the right-hand side, and we will register all operations here. So the first operation is the investment of cash. In this case, we will have an account called cash, where we put $240K in your savings. Well, the operation has to balance out, so if we change the left-hand side, we should do something else to balance out the operation. And in this case, we will have an account called equity, and we will put a balance of $240K there as well. This will be our contribution by the shareholders. Next operation, operation number 2. We have paid $120,000 for our rent. Remember the previous lecture, when we have a prepaid expense, it does not necessarily translate to our profits and losses at the moment when we made this payment. We have an asset. For example, if we terminate the rent a couple of days later because of some unforeseen circumstances, we will probably be able to recover some of the prepaid rent at least. So that's why it is still an asset for us. It is an unused asset, which we will call prepaid rent. We will have to put $120K in this asset. Again, you see that the operation balances, so the left-hand side is still equal to the right-hand side. The third operation is the purchase of goods. We have increased our inventory, put some goods into our inventory worth $100,000, but we didn't pay any cash for it. We did not still pay any cash. But what we effectively did, we got a loan from our suppliers. So let's call it a loan, this account, and we'll have to put $100,000 into it. We will still have to pay our suppliers $100,000. The next operation, we sold half the goods. Let's walk through this operation in several steps. So the first step is we'll have to collect $200,000 from our customers. $200,000. Well, that's our profit. Okay, that's the result of our business operations. So we have to put it here into our new account, which we will call profit. But that's not it. We still have to collect $40,000 that our customers still owe us. They did not pay, at least yet. So this is called receivables. And we will put this debt that our customers owe to us into this account. Again, this is our profit. As you recall from the accrual principle, is that the transaction should be registered in the period in which it takes place, not in the period when you collect the money. And that's the application of this accrual principle. This is not yet over, because when we have some revenue, we should also register some costs associated with this revenue. As you remember, we sold half the goods that we had, $50,000 worth of goods, and this is our expense. This is now a negative profit, and we have to register it to balance out the deal. Okay, the next operation, we had some employee expenses. First, we have to calculate the salary for our employees and this will go to the account named salary payable. We've calculated that we have to pay $100,000 to our employees, and this will be our cost, negative profit of $100,000. And then we will have to do an additional step, and we will have to pay $90,000 to our employees, and this will reduce our debt to our employees. It will still be $10,000, but we will reduce it by $90,000. Is that it? There is one more operation left, which we usually call the end-of-period operations. Do you remember the prepaid rent that we had? 1 year has passed, and we have to recognize 1 year worth of rental expenses. And that's why we reduce our prepaid rent by 60. This will be operation 2B by 60,000, and this will be our cost. Again, the matching principle. If you recall, we have to match all our sales with all costs that have been associated with those sales. Certainly, the warehouse rent is an applicable cost because it is required for us to ship the goods. So this is our cost, and we still have to put 60,000 of costs into our ledgers. That's it. That's all our operations for the year.
I hope now you understand how to record basic operations in the financial ledgers. In the next lecture, finally, we're going to make our first financial statements.